Hello, everyone, and happy Taco Tuesday, which post-Liberation Day now has multiple meanings. Welcome to our second half of 2025, first half of 2026 preliminary global outlook webinar. My name is Winnie Cisar, and I have the honor of leading the CreditSights Global Strategy team. Today, coming off of a spike in Japanese bond yields and the sort of dovish US CPI report, we have an action-packed webinar featuring Zach Griffiths, U.S. Head of Macro and IG Strategy, Logan Miller, Head of Euro Strategy, Regis Chatellier, Head of EM Sovereign Strategy, and Zerlina Zeng, Head of Asia Strategy. What a team. We have all been hard at work releasing a slew of outlooks for the next 12 months, and our sector analysts in the US, London, and Singapore joined in to provide updated sector snapshots. If you haven't had a chance to check out these reports, they are all up on the CreditSights Strategy landing page. Now, given that we have 1 hour and 5 panelists, we'll be going through the highlights of our outlooks. As always, if you have a question, please go ahead and submit it through the Q&A function on the software, and we will do our best to address as many as we can. We also have the emojis going, which have already been pretty active. Keep them coming, but be kind to the strategy team. We've been working hard the past few weeks to pull together all of these outlooks. With that, as we like to do on the strategy team, we are, of course, going to turn the tables and ask the audience our first question. And this is, in your opinion, the Fed is A, behind the curve, they need to start easing ASAP, so basically the Trump view, B, well-positioned to wait and see, or C, not restrictive enough, inflation is coming back despite the kind of view that June CPI report was not particularly inflationary overall. Everyone go ahead and submit your responses. Zach, I'd love to hear from you. What do you think the audience is going to say here?
I think it's going to be a mix of well-positioned and behind the curve. I'd love to see some not restrictive enough to get some two-sided risk to the current Fed call, but I'm not expecting that. I think if anything, maybe we get some more behind the curve after this morning's CPI print.
All right, let's go ahead and see what the audience has to say. Oh, and we have basically, almost unanimous expectation that the Fed is well positioned to wait and see. So holding policy rates effectively steady is kind of the way to go right now. And then an even split, exactly 8.8% of you think behind the curve, and 8.8% is not restrictive enough. Inflation is coming back. All right, so Zach, let's start with that outlook for macro and rates in the US, as that trajectory of the Fed and the US economy is definitely going to influence the direction of global financial markets. What is your take on the US CPI print that just hit this morning? How does that number factor into your expectations for Fed policy and rates over the next 12 months? And do we need to totally rewrite our outlook after we just put it out this morning?
Sure hope not. I don't think I have another outlook in me today, Winnie. I'd say a couple key takeaways from the CPI print. First, if you were looking for a huge uptick in inflation in June to show tariff pressure, we saw some signs of that, but not a huge blowout. And so probably a bit of a relief rally there from a risk asset perspective, perhaps from a Treasury perspective. I think the curve is actually bear flattening right now, so that's kind of an interesting move in response. And the other thing is, I'd say we had shelter costs come down to 0.2% month over month. That was actually the slowest pace since February 2021. So definitely more encouraging on the core side of inflation, on that very important services part. One thing I'd note there is it was driven by a big downtick in lodging away from home, which I'd say is growing evidence, or part of growing evidence, that we are seeing consumer discretionary spending slow down. And I think that's a big key, bringing this all back to our overall economic outlook going forward, that we think consumer underlying trends are softening. And that's been a call that we've heard from our consumer team for the better part of the past year. And we think that starts to become more evident in the macro data in the second half of 2025, and in particular in 2026. So when we think about the next 6 months, really what we've been calling for in 2025 as a whole is this slower than potential growth environment. That's really what you're seeing from the updated summary of economic projections. And we think that probably weakens even further in the first half of 2026, driven by a slowing in consumer spending a softening of the labor market. And we think given some of these underlying consumer dynamics, a relatively modest softening in the labor market could have big consequences for consumer spending. And so with the Fed on hold through the end of this year, we are expecting the Fed to be cutting from more of a behind the curve perspective as we go into the first half of 2026. So that's kind of a big shift in our view, pushing out our views to the next 12 months. We had been in clearly a more hawkish camp, expecting the Fed to be on hold in 2025 as a whole, but we are expecting a shift to rate cuts in early 2026, Winnie.
A shift to rate cuts in early 2026. And Zach, just to crystallize your view, what is the base case economic outcome first through the end of 2025 and then for the 6 months of 2026?
So it's a continued slowing, I'd say, and there's a lot of noise in the data. I'd highlight that in CPI as well. I think there was big inventory build, which could delay the pass on of costs. And so we are looking for growth to slow maybe toward the 1% range at the end of this year and perhaps even slower in the first half of 2026, which is where you start to see a softening in the labor market, which ultimately allows the Fed to begin easing. And so for now, we are concerned about inflation eventually showing signs of the tariff pressure. And I think the other thing that we're expecting is if you don't see too much pressure in terms of consumer prices, you're going to see it in margin compression over the course of this earnings season. So we are looking for that slowing to kind of continue through the first half of 2026. It finally starts to impact the labor market on a more sustained basis, and that ultimately is what allows or really creates an environment that the Fed has to be cutting into. They're really not cutting proactively, which we think would be our bull case scenario. I'm sure we'll discuss that in a little bit more detail. This is more of a scrambling to right size where policy needs to be given a weakening economy in the first half of 2026.
Yeah, that mix between, either we're going to see inflation in consumer prices or some sort of margin compression seems a little bit like a lose-lose in a lot of ways. Now, Logan, I'd like to follow with you here as the ECB has been a bit more proactive in easing policy than the Fed has. And we've also seen that shift to fiscal stimulus in Europe at perhaps long last. That's definitely called the relative outperformance of the US economy into question, though I don't think many people are really expecting that Europe is going to start to really outperform. How are you thinking about the path for the Euro economy over the next 12 months? And is there a way that the Eurozone could actually outperform the US in terms of economic fundamentals?
Yeah, thanks, Winnie. Great to be here. So, look, I think over the next 12 months, the focus is going to remain on how Europe responds to U.S. trade pressure, how companies manage through higher tariffs, both in terms of their investment spending plans and navigating growth challenges. And then lastly, how quickly and effectively these fiscal spending plans will actually boost the industrial economy in Europe that's faced several years now of headwinds and underinvestment. But, I think most importantly for our outlook is really the direction of travel. Right now, if you look at a range of metrics, whether it's pronounced year-to-date strength in the euro currency, steeping of European sovereign yield curves, or credit spreads near their tights over the past decade, there's certainly quite a high degree of optimism that's being priced into the European markets. And on the data front, a number of sort of soft and hard data indicators have so far confirmed much of the optimism, such as the bottoming out of industrial production in recent months. We've seen stronger PMI figures, and even Germany's economic sentiment survey that was released today came in much higher than expected. So, I think to some degree, I think the relative positive sentiment is a reflection of uncertainty about many of the things that Zach touched on regarding the U.S. outlook, which has caused a rethink among European and foreign investors about their exposures to the U.S. This seems to be indirectly and somewhat counterintuitively benefiting demand for European credit. We just have to look at fund flows, retail fund flows, which have shown very strong inflows to Euro credit, notably outpacing that of U.S. credit, as we pointed out in our monthly Credit Compass report. So, Winnie, to answer your second question, whether or not Europe can really outperform the U.S. I think there's certainly a number of supportive factors for European fundamentals, many of which have just emerged over the last 6 months or so. But that being said, from a valuation standpoint, which we would argue is the biggest challenge for investors at present, it's going to take more than the perception that Europe can sustain a slowdown on the other side of the pond based on positive domestic trends really to justify currently tightly wound spread levels. So I would argue that Europe cannot grow it alone. I think potential weakening of the U.S. and or a trade slowdown with the U.S. would translate to weaker domestic demand. And Europe, particularly considering the export nature of many countries and sectors, which I don't think is being priced into European risk assets right now. Hence, we remain pretty cautious on the direction of Euro IG and high yield spreads over the next 12 months. But perhaps based on our updated forecast, which we'll get into in more detail, we do think that Euro spreads can still continue to trade inside of U.S. IG credit, or instead otherwise, widen less over the longer term, just given that the more proactive ECB over the past year and those positive technicals that we described in today's outlook that we published.
Yeah, it's so interesting to see how the start of the year was defined by American exceptionalism and an expectation for continued outperformance by U.S. asset classes, and that inflow into European asset classes this year has been quite tremendous. Another area where we've seen some pretty solid demand, especially for those yield buyers, is in the world of emerging markets. And Regis, you have the pretty much impossible task of identifying the potential impact of U.S. policy on a wide range of EM sovereigns in your coverage. Many of those have a complicated relationship with the US. Now, I realize that the outlook for EM fundamentals is really mixed. It depends on the region or even the country, but what are some of the key trends that investors should be monitoring over the next 12 months from a fundamental macroeconomic perspective for EM sovereigns?
Yes, indeed, the situation has been quite diverse, depending on the region and even depending on countries, but overall, EM economies have been quite resilient, growth averaging something like 3.6% in the first quarter. That is ex-China. And this performance is basically in line with 2024. So we haven't seen a meaningful slowdown at an aggregate level, at least so far. Southeast Asia still continue to grow pretty at sustained pace, around 5% also. Momentum has been also improving in LATAM. Countries like Argentina, Chile, Peru have been doing quite okay with a pickup in growth. Middle East, North Africa is doing quite okay. Saudi Arabia has picked up on growth production, on oil production, but even beyond that, you have Egypt, Morocco, pretty strong growth. The region that is slowing down clearly is CE countries, with the economic slowdown in Western Europe affecting the region, and with particular emphasis on the auto sector that is weighing on exports for the region. Now, it is difficult to predict the impact of U.S. tariffs at this point for EM, but the main issue, precisely the main issue has been the predictability of U.S. trade policy and I would say the stability of global trade framework. However, I would expect EM GDP growth to be to slow down a bit, probably around 3.5% this year and until early 2026, from to 3.8% in 24. So we're going to have a meaningful impact eventually. Now, what are the trends to monitor going forward? Because again, there's a lot of uncertainty around that. First of all, the actual implementation of U.S. tariffs. Some countries have indeed complicated relations with the U.S. We've seen some tariffs increases that were decided solely based on political ground. For example, Brazil, that was hit by 50% tariffs with Donald Trump trying to put pressure on Brazilian authorities to drop the case against ex-President Bolsonaro, or South Africa, for example, that is targeted by 30% tariffs. Donald Trump considers that South African white community has been discriminated by the South African government. So beyond the economic rationale, you have some political objectives. I tend to think personally that the tariffs that are based on political grounds are going to remain higher than those that are based purely on relative size of U.S. trade deficit. The second trend to monitor is the impact on tariffs on inflation. I would say global inflation and global funding costs. If the Fed does not cut interest soon enough, I mean, it's going to be difficult for emerging markets to ease monetary policy, even though EM real policy rates are still quite high by historical standards. Another factor to monitor is momentum on GDP growth and exports. I mean, I think it's pretty self-explanatory, but I would say the main one, and probably not the one that we don't emphasize enough, is probably fiscal deficit and debt supply. Fiscal deficit remain quite high in EM and even more so in developed markets. But if you look at EM has an average deficit of 4.4% of GDP, and that is excluding China. And bond supplies have been increasing quite a lot in the past few weeks. So these are risks, we need to monitor going forward, with the caveat that we still have quite a lot of unknown as far as U.S. policy is concerned.
Unknowns as far as U.S. policy is concerned. And Zerlina, I think that is a great segue into you, as it seems that trade agreements and relationships with the U.S. and Asia are definitely continuing to evolve, oftentimes in ways that are surprising to me, especially with Trump's letters last week to Japan, Korea, and Vietnam. Is Asia positioned to withstand the tariffs that are currently in place or expected to go into place on August 1st? And how do you feel about the fundamental trajectory for different countries in the region?
Yeah, well, hi, Winnie. I think tariffs, if implemented in full scale, will likely hit the export-reliant Asian economies, particularly Japan, South Korea, Taiwan, Thailand, Malaysia, Singapore, Vietnam, and China. But so far, we are not seeing this showing up in the export data, likely because of the front-loaded activity of exports. A few markets do carry some pockets of resilience. They have trade deficit with the US, like Australia, are very much domestic activity driven, like Philippines, Indonesia, and India. And in general, Asian investors are expecting trade negotiations with the US to bring down tariff rates, particularly in Japan, South Korea, Thailand, Indonesia, where the negotiation has been ongoing with the US. And even in China, the tone looks quite positive with an initial framework, and now the U.S. is loosening some of the chip exports to China, so it looks like some positive direction to go. There is in general market hope for sector-level concessions and exemptions in autos, metals, and semiconductors. And the other thing is the strength of Asia FX against the broader USD weakness and overall very well-controlled inflation are enabling Asian central bank to maintain dovish policy stance. A lot of them are going to cut over the next 6 to 12 months to support growth. So this resulted in very strong local funding conditions and kept the Asian high-yield default rate. Asian governments are also proactively rolling out a lot of fiscal stimulus to mitigate these external uncertainties. Particularly in China, there has been a lot of infrastructure, property, consumption-related stimulus into different sectors. South Korea, under the new government, is also rolling out more stimulus measures. Japan has the SME support program as well as the auto support program. That said, we are a bit concerned about the macro outlook of Thailand because of political instability that might delay some of the fiscal stimulus rollout, and Indonesia because of decentralized policymaking and the loss of consumer confidence, as well as the confidence of some of the offshore foreign investors.
Great. And Zerlina, I think that a topic that came up a lot in April, but seems to have died down a little bit, is the rotation away from US. And that was especially true when we were talking about Asian clients. Now, how are clients in Asia thinking about the outlook for the US? And more importantly, has that much discussed buyer strike of USD assets actually materialized in any meaningful way?
I think there is very limited conviction among Asian investors about the direction of US macro. I think investors here are just as data dependent as the Fed. But most Asian investors have a quite positive outlook, I would say. It's like a Goldilocks scenario with benign inflation, still supported labor market, and slightly below trend growth. I think this gives Asian investors still a lot of reason to chase USD assets, at least for now, given the depth and breadth of the market. There is still some concern about the medium to long-term perspective. Prospect of USD since April, but overall, we are not seeing any big real money clients dumping USD assets, including the fixed income asset classes. More and more Asian credit investors, they are indeed buying into some of the cross-currency positions, especially in Asian local currencies. Australian dollar as one popular asset class, given the steep curve, good spread pickup, and also the very strong Australian dollar. Euro as one very topical asset to buy into for Asian investors because of the outperformance versus US IG, high yield, and also the very strong euro. And in particular, some of the new euro bonds issued by Asian investors are priced at very, very stretched levels. We do also see some increased interest of Asian credit investors buying US asset class, US IG, and expanding into the high yield and leverage loan space to chase the spread. The context is the Asian spread is actually tighter than US spread in the IG space. So this gives the Asian investors still a lot of reason to be positioned in US Treasury. And one last interesting observation is a lot of Asian clients, especially in Hong Kong and Singapore, are using leveraged position to go long in US Treasury because of the collapse of HIBOR and SORA over the past 2 months. We are seeing very aggressive, like 10 times leverage buying 30-year US Treasury.
Yikes, 10 times leverage buying 30-year US Treasury. Feels like that could go a bit sideways. So let's get to our next audience polling question, which is markets have posted a tremendous recovery since the depths of Liberation Day. Over the next 12 months, which do you think will be a more important driver of sentiment and valuations? Is it A, strong technicals and cash on the sidelines, which I think a lot of people have attributed the most recent rally to, B, improving fundamentals, or C, the more negative fundamental outlook, weakening fundamentals, rising downgrades, and defaults? And as people are submitting their responses to this question, I would like to remind everyone that you can ask us questions using that Q&A feature on the On24 software. This is a topic that Zach and I spend a lot of time debating, that technical versus fundamental, as so much of our view in the Fed rate hiking cycle, which began in 2022, and our expectation that we were not going to see a recession, was predicated on all that ample liquidity that had been injected into the system from both easy monetary policy and a lot of fiscal stimulus. Now, the big question is, how much of that cash is still on the sidelines? And is there a point where fundamentals get weak enough that people don't care about the cash and they just want to stay all cashed up? All right, let's see what the answer to this question is for our audience. And we have, a more bearish audience. This comes as a little bit of a surprise to me. Maybe everybody has read our outlook and they are fully convinced. Weakening fundamentals, rising downgrades and defaults get almost half of the votes, whereas strong technicals, cash on the sidelines is the second most popular answer. And then 20% of you, bullish optimists. Do we have equity investors on the call? What is this? Improving fundamentals. All right, Zach, I'd like to circle back to you. Oh, actually, we have another audience question. Sorry about that. And then this is, which U.S. asset class do you expect to generate the strongest total return performance over the next 12 months? We've got cash, we've got long-dated U.S. treasuries, we've got U.S. investment grade, U.S. high yield, U.S. broadly syndicated loans, or I'm a crypto bro. We're just going to buy all the Bitcoin, the Dogecoin, the Ethereum, all of those crypto things that I don't really do much in. While people are responding to this, Zerlina, there's a question from the audience about, can you identify factors behind Asian demand for USD credit and treasuries? Can you just speak to a little bit more about those demand drivers from Asian investors?
Yeah, I think a few factors. The first is about the relative value because right now Asia IG is trading 10, 15 basis points tighter than US IG, and historically it's about 20 basis point wider. So relative value is really much better for a lot of Asian investors in US IG, and they love investing in the big names that they are like well known to the Asian credit investors. Second big reason is the size of the Asian US dollar market is shrinking because of the continued negative new supply of the past 2.5 years. A lot of investors are trying to diversify outside their pure Asian mandate. Other than US IG, Euro IG, as well as Australian, Japanese financials, even like Middle East banks, these are all the areas that the Asian investors are looking to expand into. The third reason is just we have a lot of regional accounts investing in the USD asset class compared with the onshore rates in markets like Korea and Taiwan and China. USD yields are just way too attractive, even despite the very stretched spread. I think quite different from North America and European markets. Here we have a lot of all-in yield buyers, so even the spread level is tight. People are not looking at that, and they are purely focused on carry, total return, and all-in yields.
Yeah, that makes a ton of sense. Thank you so much, Zerlina. All right, so getting back to this audience polling question, we have kind of a mix of expectations here. Now, I would like to shout out the 20% of the audience who are crypto bros. Good luck with that. We do have the top pick is US high yield. Now, this surprises me a little bit given that fundamental erosion was also kind of the consensus expectation for driving valuations over the next 12 months. Second to that is US investment grade, which I think does actually present kind of a compelling all-in yield buying dynamic. Zach will get into that a little bit more. And then we have long-dated US treasuries, broadly syndicated loans kind of at the bottom of the stack, and no love for cash, only 5% of the audience. So Zach, let's circle back to you. Let's discuss some of the macro recs and your most recent views on US IG corporate credit. Are you thinking about our base case for the next 12 months? Where do you see the most value in the US Treasury market? Should we be loading up the duration boat around current levels?
Thanks, Winnie. Yeah, just to start with the Treasury picture, I know I didn't hit on that earlier. We had a slide looking at our calls relative to the Bloomberg consensus and forwards, and I'd say we have a more nuanced call over the next 12 months. It's really a tale of 2 6-month periods where we are maintaining our 4.75% 10-year Treasury yield forecast for year-end 25. And I think the way we are positioning that to clients is highlighting the risk that yields can move higher from current levels, particularly at the long end of the curve between now and the end of the year versus really a point estimate for year end. And the way we're thinking about that is they're going to be better entry points to add duration, at least at the 10-year point, at some stage over the next 6 months. Now, with our expectation for growth slowing, the Fed to begin easing, and the really economic picture, I'd say the fundamental picture to start showing clearer signs of weakness, a shift in this pretty exuberant risk on environment we find ourselves in today, that pushes the 10-year yield to 3.5% in our base case in the middle of 2026. So a big move lower. That's quite a bit lower than consensus, way lower than forwards. And I'd say the way that we're looking at that is our weakening growth scenario drives a somewhat lower yield environment, just a little bit flattering curve when the market is priced for. And so putting all of that into our IG view, we do remain underweight US investment grade. Our spread target for the end of the first half of 2026 is 130 basis points on IG. And the way we're really thinking about that is just a return to median, a pricing back in of credit risk into the system. And we think some of the liquidity in the system is going to shift from feeling so abundant, as Winnie alluded to sort of shifting those dynamics as Treasury rebuilds its cash balance and the Fed continues its quantitative tightening. And so the way we want to position in US investment grade credit today, we like remaining up in quality. We think single A's, both in corporates and financials, are sort of the sweet spot, and we'd prefer at least in the near term, to remain up in, or shorter in duration, I should say, and we're going to be looking for better opportunities to extend duration, particularly for total return focused investors. If you are in that excess return cohort, we aren't looking to add spread duration, obviously, at these levels as valuations are rich, and we are looking for spread widening. So it's a nuanced view from a few different perspectives, but we are expecting yields to kind of stay in this range and perhaps move higher through year end, offering better entry points. Our call is for spreads to widen as credit risk is priced back into the system, and some of the liquidity that we felt so far this year starts to fade. And that's how we are thinking about the market today. We'll see if that changes over the next day or the next week, but that's how we're taking all the inputs and factoring them into our positioning recommendations.
Great, thanks, Zach. Kind of a follow-up to that, how long on the U.S. Treasury curve would you go? 10-year max given dismal fiscal picture, et cetera? Or are we going to just buy up all those 100-year zero coupon Treasury bonds that are coming our way?
That's a great question. One of the ways we've been looking at it is real yields. If you look at the 30-year real yield, it's 2.65%. And while we are concerned about deficits and what it means for the longer term fiscal picture in the US, if you look at economic slowdowns, and we're not calling for a recession, but economic downturns, that ultimately is the bigger driver, and you see yields fall and really the curve bull steepen. So I'd say in general, we are more comfortable moving out the curve if we see yields move to maybe say 5%. I think that's just a touch higher, or we are there today on the 30-year. Looking at it from that real yield perspective. So I'd say in general, we are comfortable moving out the curve as we think focus will ultimately shift from deficits to a slowing growth picture and a Fed easing in the first half of 2026.
Great, thank you, Zach. So on the U.S. leveraged finance side of things, for U.S. high yield, technicals have perhaps been even stronger than in the U.S. IG market, with robust inflows after that Liberation Day risk-off move and pretty limited new issue supply, especially on a net basis. Now, despite most sell-side desks expecting a dramatic pickup in primary market activity this year, we still have prohibitively high borrowing costs, keeping a bit of a lid on M&A and refinancing activity, especially for lower-rated issuers. Now, we are not going to argue with the recent strength in technicals, and indeed, cash on the sidelines did underpin some constructive calls on U.S. credit in recent years. That being said, we worry now that the credit fundamental picture leaves high yield more susceptible to shifting risk sentiment, particularly if recession fears again rise. The recent upgrade cycle is starting to lose some steam, with cyclical sectors like home builders and airlines facing more headwinds in recent months. Even consumer goods in the high yield market has a higher alignment to discretionary categories, while the Uber tariff exposed auto sector is already trading at very tight levels in the high yield market, given mostly auto suppliers there. Now, overall, we do find it a bit difficult to justify spreads below 300 basis points, even if yields are still around 7%, as we expect that downgrades and defaults will begin to edge up again over the next 12 months. Our official high yield default forecast for the year-long period ending June 30th is 3.5% to 4%. So that would mark a modest step up in defaults, still historically rather low, but definitely higher than it has been for the past year or so. Now, with this in mind, we have an up in quality strategy in the high yield market. We don't mind taking some duration risk in BB rated issuers to capture some yield and spread there. Valuations are really bifurcated in high yield. It makes it very difficult to construct a 7% portfolio without taking at least some CCC risk or reaching into sectors that have been a little bit more beaten up as of late, like telecom. Indeed, that sector is our sole overweight recommendation, as we see the shifting policy mix as a more positive catalyst, while event risk and access to liquidity in the ABS market provide some additional support to the telecom sector. Now, within the broadly syndicated loan space, our call for a faster than anticipated decline in base rates and preference for duration over credit risk leaves our appetite for loan risk rather low. Loans have already lagged high yield this year despite high base rates, as prices are already quite high for double B and single B rated tranches, and that leaves limited incremental price appreciation. While the loan market effectively cleared out a lot of its liquidity and refi risk in last year's issuance bonanza, other positive event catalysts like a rapid rise in LBO activity or sponsor-to-sponsor M&A has really yet to materialize, and that has resulted in a higher prevalence of dividend recap deals in the market. For the BSL market, we see the lowest potential for total returns in both our base case and on a probability weighted basis. So as we're thinking about recommendations for yield-based buyers, I would say that we prefer US investment grade first, high yield second, and leverage loans third, with an underweight allocation to kind of credit risk wholesale and a view that excess returns are probably going to come under some pressure over the next 12 months or so. Now, Zerlina, I'd like to get back to you, as I've been pretty shocked by the resilience of the Asia market. You did outline a lot of the technical factors that have been supporting it. Asia IG spreads very tight to US IG, Asia high yield back in the low 300 basis point area. What has driven this incredible compression in spreads, and where can investors still find some value in these markets?
Yeah, we're also quite shocked, and this is the second year, both 2024 and year-to-date 25, Asia IG and high yield beat US and European peers in total return year-to-date, just lagging the EM sovereign. Markets that are in the crosshairs of US tariff, like Greater China, Korea, Japan, deliver the best performance, like very surprisingly. I think a lot of this strength is attributable to the benign macro backdrop. We are not seeing this tariff risk flowing through into hard data. And again, the strong technicals, it's not just about the negative net new supply, but also the very strong regional inflows from different yield buyers, Chinese accounts, Korean accounts, wealth accounts in Southeast Asia, and nowadays even some of the Middle East related wealth accounts. And the Asia high yield default rate has been normalizing with the very good onshore funding conditions, and the China high yield property default is already behind us. So overall, I think we still have some this preference over for duration risk over credit risk. This has been the case since April this year, given the spike in yield, but the spreads has been very stretched, and we think if there is a potential retreat of risk sentiment because of the US macro situation, then Asia spreads are very vulnerable to any very significant widening. And here we are talking about the idea of diversification. We are seeing this as the best protection for Asia credit portfolio. So for duration plays, we are talking about diversification across the Japanese lifer sub-debt, Greater China ATAC property, some of the Southeast Asian quasis with very steep curve. But honestly, in Asian credits, the long-ended duration supply is limited, and also the curve is not as steep as US IG credits. And for credit risk, we are doing a barbell strategy. So we both position in quite defensive names like China IG, some of the Hong Kong A-rated names, but we also do some beta, though we are quite selective in terms of both IG beta and high yield credits in Asia.
Excellent. Thank you, Zerlina. So Regis, back to you on the EM sovereign market. You know, they fared pretty well this year, though EM IG sovereign spreads are still the widest of the markets that our strategy team tracks. Do you think that the strong performance so far is set to continue? And how do you recommend investors allocate portfolios in EM sovereigns?
Yes, I would like to start with one remark. I mean, indeed, sovereign IG bonds trade wider than US corporate IGs, but still trade pretty tight. They have outperformed thanks to longer average duration. So, in fact, if you look at sovereign IGs, they have an average duration of 7.8 also, which is about 1 year longer than US corporate IGs. So that obviously helps as you had US Treasuries, tightening. But yes, overall EM performance has been quite decent, including for sovereign high yields. They're up by 5.3% year to date. That is a bit higher than sovereign IG, so a pretty decent performance. That being said, valuations are very tight. We are downgraded EM sovereign IGs to underweight. Spread valuations are within the 1% most expensive since 2013. And we remain even more cautious on EM high yields, simply because spreads are very tight and more vulnerable to global repricing and on risk appetite. We would expect spread differential between sovereign high yields and sovereign IGs to widen to 400 basis points or so from 270 basis points currently, which is very, very tight by historical standards. As far as allocation is concerned, I mean, we are pretty defensively positioned on across EM. If I take the best pick, I would say Saudi Arabia. We outperform on Saudi Arabia. Credit fundamentals are, are strengthened, as demonstrated by the recent upgrades from Moody's and S&P. Growth prospects have improved. They are increasing oil production. That's going to help GDP, obviously. But beyond that, there was some concern before on risk for fiscal slippage. I think this risk is quite contained, and debt levels are pretty low anyway, and FX reserves are huge. So I think risk reward in Saudi Arabia is pretty attractive, especially if we consider that we could have a global repricing. On kind of a more high yield spectrum, I'm quite defensive. Morocco is a bit of a frontier market, but I think it's going to outperform. I think down the road, it could be even upgraded. You have pretty strong FDI and pretty strong tourism industry. Public debt level is quite high, but fiscal outlook and fiscal trend is positive. So I would say also risk reward is attractive, but again, this is a pretty defensive position relative to the rest of high yield. For the big names and the IG names, I would certainly avoid Mexico right now. I don't think all the risks are priced in. Of course, there is the US tariffs story, but beyond that, there is the risk on Pemex, the state oil company, that is increasingly weighing on the budget with increasing financial support from the government. So I would expect that will continue, and I'm not sure that everything is priced in at this point, knowing that Mexico tends to be a bit of a high beta within the IG space. So I would expect it to underperform. Lastly, on the underperform side, Egypt has been quite performing quite well in terms of like economic recovery, and inflation is down. It's been a bit the darling recently with a lot of investment from GCC countries, but the fiscal situation is quite alarming, to be honest. We could expect something like a deficit of 12% of GDP, one of the highest in the world, in fact. And we still have some disruption to the Suez Canal because of terrorist attack, and that has negative impact on public finances. But beyond that, in the very high yield spectrum, valuations are very, very tight. And I guess if there is a repricing, the kind of names like Egypt or Nigeria could easily widen and underperform as we have a global repricing. That's it for the allocation, I would say, on my side.
Thank you, Regis. So Logan, let's go to the European and sterling credit markets. Euro especially, as you noted, has really benefited from that range of technical and fundamental factors, maybe part perception, but part reality. You have been a little bit more constructive on Euro high yield. That trade has worked out pretty nicely. And now, how are you thinking about allocations to Euro IG and high yield over the next 12 months?
Yeah, look, we maintained our underweight recommendation to Euro IG going into the second half based on the basis that valuations are pricing in, I think, too much optimism around fiscal spending, especially in the very near term, as well as sort of the newfound European exceptionalism theme that's emerged this year. And also not reflecting the reality that tariffs are negative for fundamentals and growth, even if it's a bit more nuanced than we thought it would be back in early April. I think it remains to be seen, how effectively and quickly fiscal spending translates to positive momentum in the private sector. That being said, in terms of our recommendation, it's not to be outright short or sell IG credit, as we realize balance sheets are in a reasonably good starting place, and there are also fewer alternatives outside of credit in Europe that offer compelling yield. I think that's certainly a key technical driver for demand that we've seen. To that point, the ECB has been considerably more dovish than other central banks, which I think is certainly helping demand for Euro IG credit from a non-Euro perspective. We are forecasting a slower grind wider compared to our original year-end 2025 forecasts, which we have taken down to 100 bips for Euro IG in our updated base case scenario. Instead, I think what it comes down to is I think we expect and we recommend that investors take a more tactical approach to allocating to Euro IG via sector strategy and credit selection. We've been recommending to take advantage of pockets of strength, like we've seen in recent weeks, to move up in quality into companies that have defensive balance sheets and sectors that the market that look compelling on a kind of a long-term basis. And we publish a monthly, obviously our Euro IG sector strategy RelVal monitor each month. I would highly recommend taking a look at that for some opportunities. There's also some charts on our outlook today. But over the longer term, I do think we are expecting spreads to widen back towards the longer term average in the first half of 2026. So kind of a continued widening over the next 12 months. We're forecasting IG spreads to end the first half of next year at 120 basis points. I would note, however, that this is slightly below our more bearish view coming into the year. For Euro high yield, we're sticking with our call to be market weight for the second half of 2025. We continue to view all-in yields as compelling for dedicated high-yield investors. And as I mentioned, as you have lower yields in IG, it does also create an impetus for some IG investors to kind of dip down into double Bs. Fundamentals, particularly for double Bs, are about as strong as they've been in recent years. Most companies have already addressed near-term maturities. Leverage remains intact at multi-year lows, while interest costs are becoming less burdensome compared to recent years. So we're expecting to see spread widening, alongside IG over the course of the next year off of extremely tight levels. But total returns should outperform Euro IG at around 2.5% on sort of a forward 12-month basis, or even higher, based on our probability weighted forecast of around 4%. We also expect high yield bond defaults to remain somewhat steady, but well below sort of peak levels in a range of 2.5% to 3% by the middle of next year, which I think is already being reflected in kind of market implied distress ratios at the low end of the rating spectrum. So in short, we think that strong technicals that we've seen in this year and even in recent years can remain intact as long as the growth picture continues to hold up, which we are expecting it to do.
Great. And then Logan, do you have any quick thoughts on the sterling market? I realize it's a little bit smaller, but still one that people ask about regularly.
It is. Yeah, sure. So look, I think the technicals for sterling IG have been underpinned by pretty limited new issue supply, as well as kind of UK liability-driven investors locking in pretty compelling, book yields, which is a reflection, I think, of elevated financing costs, as well as just kind of a lack of new money borrowing in recent years. But from a valuation standpoint and credit specifically, sterling IG is basically at the tightest level since before the great financial crisis. I think given our concerns that we wrote about in our outlook around spread duration, I think sterling IG is far more sensitive even to incremental moves in spread. So, we're forecasting, for excess return to notably underperform over the next 12 months. I also think in many ways, the Bank of England is in a very tough spot. Inflation pressures have certainly seemed to resurface in recent months, while growth has also been quite tepid at best. So, we think that the Bank of England should be cutting rates. Our concern is kind of similar to your views on the Fed, that policy may already sort of be behind the curve. The UK is also kind of dealing with a somewhat fragile fiscal situation around the budget and deficit spending, which has left gilt's quite vulnerable to a number of sell-offs already this year. So, kind of with those factors in mind, we think that the risk-reward proposition is skewed to the downside. And so we're sticking with an underweight call on sterling IG.
Excellent. Thank you so much, Logan. So we're going to get to our next audience polling question, which is a, kind of segue from what we were just talking about with our cross-asset recommendations. So outside the US, what is your preferred market for total return performance over the next 12 months? Do you like Euro IG, Euro high yield, EM sovereign IG, EM sovereign high yield, Asia dollar IG with those very tight spreads, or Asia dollar high yield? You can go ahead and vote now. And there is a question from the audience, Zach, that I'm going to have you answer while people are voting. If we have this weakening growth scenario, but there's currently a pretty large and getting larger fiscal deficit in the US, what do you see as the impact on the SOFR swap basis?
Yeah, it's an interesting one. I feel like this has been a hot topic with the changes in SLR regulation, arguing for wider swap spreads or less negative swap spreads. The big thing I think that we've seen happen is treasuries have cheapened versus swaps as there has been so much issuance. And one of our big concerns coming into this year was more issuance further out the curve as deficits remain large and potentially widen going forward. What we hear from Treasury Secretary Bessent is they are not looking to term out debt, and given the passage of the Genius Act, we think they're going to rely more heavily on the front end of the curve for a sustained basis. And so, in general, we're not looking for swap spreads to become even more negative in terms of Treasuries cheapening more, because we're not looking for that supply to be termed out as much. And so, if you're thinking about 10-year swap spreads around 50, 55 basis points, I don't think that gets a lot more negative from there. Moving further out the curve, something in the 85 to 90 basis points range for 30-year, we're not looking for that to worsen. So that's been kind of a big shift, and also adds to why we are a little more comfortable with yields moving lower across the curve in the first half of 2026.
Great, thank you, Zach. All right, let's see what the audience has to say about their preferred non-US asset class. All right. We have some Euro bulls in the house. Between Euro IG and Euro high yield, we have about 58% of votes. Less love for EM sovereigns, and then very little bullishness on those tight Asia spreads, both in the IG and high yield markets. All right, last audience question that we're going to ask today. What do you think is the biggest risk facing markets in the next 12 months? Is it a reacceleration in global inflation, a demand drop-off or slowdown, liquidity stress from restrictive monetary policy, geopolitical escalations, or something else? You can drop it in that Q&A box and let us know. You can go ahead and vote now. And while everyone is voting, Logan, I'm going to ask you an audience question, which is, why would US growth slowdown be a drag on Europe? We are curious if you can dive a bit deeper into that.
Yeah, I think there's probably a couple things there, but clearly those, the U.S. is very interconnected with Europe. Number one, U.S. is the largest buyer of European goods, so it's the largest export. It's Europe's largest exporter, and this has actually increased pretty substantially in recent years. So I think a slowdown in demand from the U.S. would certainly put renewed pressure on the ability for Europe to expand, given sort of the trade surplus that I mentioned. The second thing is that there's a large share, I think more than 50% or so of European revenues, at least if you're looking at companies in the Stock 600, generate revenues outside of Europe. So clearly, I think a meaningful slowdown in the largest economy in the world, that is the U.S., coupled with euro strength, puts downward pressure on earnings growth, which I think we actually might start to see some of that come through in second quarter earnings. And then the last thing I'd probably mention is, a slowdown in the U.S. and sort of weakness in the dollar makes it obviously much more expensive for U.S. investors to spend or U.S. Tourists to spend their holidays in Europe, which certainly has helped buoy up, growth, especially in destination countries in recent years. So those are probably the three things that come to mind.
Great, thank you, Logan. All right, so biggest risk facing markets. people are a little bit mixed, undecided. I'm surprised that geopolitical expectations comes out at the top by, just a small margin, as the markets have really shrugged off any sort of geopolitical risk for quite some time at this point. Reacceleration in global inflation is number 2, but very closely followed by number 3 at demand slowdown / drop off. Liquidity stress from restrictive monetary policy. No one or very few people really expect that. All right, so let's do a speed round. And I'm going to have everyone tell us, what is your top risk that you think is underappreciated, or what's the most contrarian view that you have for the next 12 months? And Zach, let's kick it off with you.
Winnie, this is a perfect lead-in because mine is liquidity will start to dry up in the second half of this year as you have Treasury rebuild its cash balance, a couple $100 billion. What's a couple $100 billion amongst friends? And even though the Fed has been doing QT for 3 years now, bank reserves in the system are actually up 0.8%, as that's all been absorbed by the overnight reverse repo facility so far. So we are expecting reserves to fall in the second half of this year and going forward. And I think even though liquidity seems ample now, I think that rate of change versus the actual level becomes more of a driver of markets in the second half of this year. I think that's an underappreciated risk.
A little bit of liquidity stress coming our way. Logan, how about you? Underappreciated risk or contrarian view?
Yeah, I think the top risk to our outlook is that compressed or even tighter spreads remains the pain trade over the next 12 months. I would argue that based on asset price growth relative to economic growth, perhaps the ECB has loosened policy too much, especially considering that financial conditions are now much more accommodative in Europe compared to the rest of the world. I think that means that investors are having to take on more credit risk to achieve a reasonable level of reinvestment yield. It also means that companies are being incentivized to pursue more aggressive financial policies, potentially at the expense of creditors. And that's particularly if kind of real investment spending due to tariffs remains quite low. So we've seen minimal M&A issuance over the past few years, but now that the cost of debt is for larger acquisitions and inorganic shareholder returns is much more affordable, we could see releveraging activity surprise to the upside over the next 12 months. So while perhaps a positive theme for European equities, I think it would skew more negative for IG than in high yield. So I suppose that supports our underweight recognition to IG versus our market weight allocation to high yield.
Back to the world of intentional releveraging. Okay, Regis, how about you? Key risk or contrarian view?
I guess the main risk is still, Donald Trump keeps postponing the actual implementation of tariffs, and in that case, the market could become even more complacent. And investors continue to pile on EM assets purely based on relative carry. But of course, ultimately, these tariffs could be implemented and likely to be implemented somehow and much higher than before. And this is where, repricing becomes quite aggressive. But in the meantime, in this scenario, it could be quite smooth. But the top risk that the market is probably underappreciating is probably the fiscal risk, with heavy debt supply starting to affect risk appetite ultimately. So that's basically a concern. It's been very much under the radar so far. I guess the standard of US has put a new standard in this respect, but still, this is a risk.
Great, thank you, Regis. And then Zerlina, I'll go to you next.
Yeah, I'm trying to debate between the two. The first one is one supporting factor for Asia credits in the past 2 years has been the technical tailwinds. We have negative new supply, but I think this might decelerate or even turn around to a headwind because we just have so much new supply from Japan, Australia, and the Middle East, and a lot of Asian investors are diversifying into this region. So that might have some big impact on the secondary curve. And the second one I'm thinking about is investors are turning quite comfortable with high yield property credits in the region. A lot of the market participants are thinking this property saga is behind us, but we do still have some situational names waiting for liquidity and refinancing plans. And if that does not work out, we might have credit contagion into the broader Greater China banking sector, and the overall Hong Kong CRE market is still quite sluggish. So these are the two I'm thinking about.
Thank you, Zerlina. We never like to hear the phrase credit contagion when we are on these types of webinars. All right, so my key risk, and perhaps a contrarian view, is I don't know that fundamentals are at this point as good as everybody seems to believe that they are. In the labor market in the US, we have a falling participation rate. That's historically not a great leading indicator. Consumer fatigue is pretty evident in discretionary categories in today's CPI print, and we're starting to see some stall out in wage growth. In credit markets, interest coverage has already reset meaningfully lower. This leaves less flexibility for any sort of EBITDA headwinds or persistently high borrowing costs going forward. And it seems to me at this point, from a ratings downgrade perspective, there's not a lot of room for incremental positive momentum. It kind of seems like ratings have a little bit more of a downward bias going forward. Now, Zach, we're going to end on a really cheery note here with the last question from the audience. And that would be, do you expect US Fed will remain independent from Treasury, or may there be an attempt to influence engineer long-term rates? What say you, Zach?
I think the Fed ultimately remains independent, but there's definitely been long-term damage done with how much heckling the current administration has done on Chairman Powell and making a specter out of this remodel. I think it, in the long run, is likely to keep inflation expectations a little bit higher and call into question how much presidents in the future will be willing to kind of lean on the Fed. So ultimately it stays independent. I think there is some damage done that will be reflected in market pricing going forward, but Fed's not going to get absorbed into Treasury anytime soon.
We definitely hope not. All right, with that, we're back at the top of the hour. Time flies when you're talking global strategy. We're going to wind down our webinar, and I would like to say we only had 2 thumbs down emojis today, proving yet again that CreditSights clients are truly the best clients. Thank you for the self-esteem boost. Thank you for joining our discussion today. Now, we do love to hear from our clients, so if you have additional questions, please reach out directly to any one of us or your sales representative. Best of luck to everyone in the second half of 2025. Before we know it, 2026 will be upon us, and we'll have a whole new acronym to use in our daily conversations. With that, we are going to end the webinar. Thanks, everyone.